What's up, team? Sean from Rest to Live here. And I want to really put a exclamation point right at the beginning here that what we're going to be discussing is the idea of tokens, cryptocurrency, the ways VCs invest, the ways that they're investing that you may not know about, why things like FTX happen, who might be next, and how we can better understand what this entire process looks like. So that's what we're going to do. This might be a long video. I'm sort of just getting rolling in my thought process, but I wanted to really share this in real time. So one important distinction I want to make as we get kicking off here. I'm an angel investor. I do invest in companies. I do not invest in crypto or token related companies. However, a lot of them have come across my desk going back to probably 2016 or so, 2017, we really started seeing them. I'm going to get into why I was never interested in it and why I was also so surprised when we saw huge news come out of Sequoia a little while back as well. So let me just start off really high level here and say, I think it's really important to understand that when we're talking about the crypto world, because I think there's a ton of confusion, there is a very, very, very significant and large difference between cryptocurrency, right, which is a digital currency used to facilitate transactions on a blockchain, versus tokens. Tokens are very different. It represents an asset or a specific use case, and can be transferable, can be looked at as an investment, can be potentially a store of value, right? Or you can make purchases, etc. So it might sound the same, but it's not the same. Ethereum has Ether. Bitcoin, of course, is B2C. But there's other tokens that can be built upon those blockchains that might do different things or different services. But it's interesting because those tokens create an opportunity for a lot of bad things to happen, okay? And facilitation of how we build those and look at those can create a lot of big issues as well. This is why we saw a lot of these ICOs get cracked down upon by governments. This is why 95% or so of everything that's happening in this space is not happening in the US because we're regulated. So it's important to understand that there's a reason why a lot of these exchanges that are blowing up overseas. It's because, put frankly, they can't operate here. So I just want to call it out that although the words are oftentimes used interchangeably, there is a difference in its truest form of a cryptocurrency and a token. I know there can be argument back and forth, but just for an understanding perspective. So look, let's start at the high level and work our way down to the bottom of the floor here, because I think it's really important that we understand where we are and what's happening. The most recent piece of news, and we're going to work completely backwards to where we get to. We're hearing now that crypto.com might be in trouble because very much like a lot of these other exchanges, they have massive exposure with the fall collapse of FTX, FTX US, and Alameda. It's exposed massive issues across the board. Now, the reason why, as an example, crypto.com could be in trouble is because 20% of their reserve assets are sitting in Shiba Inu coin, okay? Now, I want you to just sit back and think for a second. When you are putting your reserves in something like a crypto, like a coin, whatever it is, and it's wildly volatile, okay, there is a huge opportunity for things to hit the floor and wipe you out. So if 20% of your life savings is in something that could theoretically go to zero, that's not really much of a reserve, right? There's a reason why across the globe, the dollar is typically used as a reserve currency. It's relatively stable. It doesn't mean that it doesn't go through times of strength and weakness, but for the most part, it's relatively stable. So after all this FTX debacle, now we're seeing even crypto.com showing some cracks because of things like that. There's other reasons as well, but I want to call it out because it's important that you understand the functional difference between crypto and tokens, reserve currencies, how these companies are doing things. Now, typically speaking, the way this should work is using like a Gemini or a Coinbase as an example. If I put one Bitcoin on the exchange, they have to, in fact, have one Bitcoin on the exchange, right? It has to be secured there. It's not their money, it's my money. I'm just using their platform. What's happening with a lot of these exchanges, as we're finding out, and it's going to get deep here in a second, so bear with me, is there's commingling of investor money being transferred into different types of tokens. Those tokens have different valuations. Those valuations can fluctuate wildly, be created out of thin air, accelerate and decelerate in value very quickly. So let's pause there for a second, okay? We hear all this news also about Sequoia. Sequoia is a massive, massive VC firm, okay? So Sequoia Capital, going back to, I actually wrote the date down. I was trying to put my eyes on it here. I'm probably going to forget the date. But going back to about February of this year, they basically announced that they are going to blow up the traditional VC model, right? It's not working. It's no good. We're going to do something totally different. And what they want to do is create a brand new crypto fund. Now, this was funded anywhere in the range of 500, 600, 700 million or so. I don't know what the final number was, but I wanted to just call it out. That the idea of what Sequoia was doing was create a crypto fund that would focus on liquid crypto investments, tokens, okay? And it was going to be enabled by Sequoia as a registered investment advisor. So just think about that, right? And this is a quote here. We could buy these out of our seed or venture or growth funds and be mostly passive, and have done some of that, but it's not really what LPs or the crypto community wants. And this is what Sequoia's Alfred Lin said. This fund will let us manage these tokens differently, from staking to voting rights and having a say on governance. Correct me if I'm wrong, team, but that sounds a whole lot like a security, right? I'm investing in something that comes with voting rights, transferability. It pays interest or a dividend, perhaps. That seems not really like a currency. That sounds just like a security that should be therefore registered with the SEC in the US if we're doing business that way. Okay. And additionally, an interesting point from Sequoia, and I'm bringing this up because of what just happened with them. They also added that 20% of Sequoia's investments over the past year have been for crypto startups. And they believe that such deals will continue at a brisk pace. Now, the reason this is such a big deal is because just recently, as in like a few days ago, Sequoia came out and said it had put in just over 200 million into FTX, and it's essentially now worth zero. Okay, so let's put that in a bucket for a second. Okay, now let's talk about what a lot of these companies have done. So I want you to imagine that I am starting a brand new company. We're going to call it Sean Inc. Okay, it doesn't matter what I sell because let's be frank, most of these companies don't do anything. So let's call a spade a spade. I open up Sean Inc. I haven't even decided what I'm going to do with it yet, but I'm going to raise capital for it. So I go to a bunch of VCs, maybe some angel investors, maybe I even go to some hedge funds or some asset managers. I say, hey, look, I want to start a company. Here's the deal, though. I don't exactly know what I'm going to do, but I want to raise a bunch of money. And they're like, well, that's crazy. I would never invest in you, right? Of course. Why would you invest in something for no reason? There's no cash flow. There's no business idea. There's nothing there. But what if you could invest in me and I could create my own currency out of thin air? So I now have the Sean token, right? Or as we often joke on this channel, the Shiba Ding Dong Kangaroo coin, right? So SDDK token, and I can go and create as many as I want, and I can offer people insane rates of returns. I can say, hey team, I'm going to pay you 40% a year for every dollar you put in, and transfer into FTT or into Shiba Ding Dong Kangaroo coin, okay? Because what do I care? I'm just going to keep creating more and more. And as more money comes in, I'm going to create more and more and more. And because those tokens can now be traded on the very company that I've started, I have a market to go and sell those to new retail investors. So huge players, investors, asset managers, hedge funds, VCs can come in and get a whole bunch of, Shiba Ding Dong Kangaroo coin, and then go and take them and just sell them and get money back or make 40% on their money. And now in a traditional model, right, they're investing their money in because they think there's going to be a long-term play over maybe a decade. They'll get their money out for a big return. Maybe they'll reinvest for something new that's going on. But this created a whole new dynamic where companies could just create their own money or their own value, their own tokens. But again, the problem here is that still sounds an awful lot to me like security, not like a currency. But let's digress. Let's go one layer deeper. For those who are not familiar with venture funds or any kind of sort of growth fund where they might be investing in early stage or mid stage, typically the way it works is like this. There's a general partner, that's the fund, who manages the money, manages the operation, and there's limited partners called LPs. An LP is typically going to be an accredited investor who invests their money into the fund. And typically speaking, in venture capital, it's very important you understand venture capital is very specific. Venture capital, those funds are typically going to have a timeline on them. So although you will occasionally see what's called an open-ended fund, which means it sort of just goes on forever, which is very ironic because that's what Sequoia came out and said they were going to build. With typical funds, you see 10-year terms, right? So let's just say I go out to all the LPs. I say, hey, I'm raising $500 million. My goal is to deploy $500 million. I think I can make, I don't know, a 20% return on it, whatever the case might be. And at the end of the 10-year term, we're going to exit all of our opportunities, get your money back with the 20% return or more, hopefully, or less if I miss the boat. And you can decide to come back into my fund, invest in other funds, invest in a new fund. So this creates an unnatural timeline to deploy capital quickly and at scale and competitively against other big funds who also have to deploy capital into, let's be honest, a rather small bucket of very qualified opportunities. So with every concentric circle we go outside of qualified, we get slightly less, slightly less, slightly less, slightly less, right? Which another way to think about this is pretty risky, more risky, more risky, more risky, really risky, right? So we've got hundreds of billions of dollars, trillions of dollars trying to get returns for the limited partners, LPs, okay? And they have 10 years to do it. So the way they'll typically do it is they'll go to those LPs, they raise the $500 million, and they say, okay, you hold on to your money until we start investing it. Then I'm going to call you and say, hey, Sean, I need that 20 million you said you'd invest in the fund. Please write a check. Okay, I'll write a check. They go and deploy that capital. The problem is it takes time for these small startups to actually start growing and start building. So that's why you typically have like a 10-year term. So they want to try to deploy as much of that capital in the first 5 years as possible, okay? Because then they still have 5 years to get the returns to come in. Now, part of the BS of the entire world of venture investing is because so many other companies are trying to do the same thing, you actually create somewhat of a bubble. I don't want to call it a true bubble because it is, at least for the most part, traditionally been limited to accredited and qualified money. So when it blows up on them, not on the retail world. So what'll happen is I invest in project A for 20 million. Another VC firm is like, shoot, I got to deploy capital. So, 6 months later, the company goes back and wants to raise more money. Now this company's going to throw their money in at a higher valuation. I see that it's growing well. I'm going to deploy more capital into it. Third round comes in, another VC wants to pop in because they have to start deploying their money. They're paying an even higher valuation, but they have no choice because they have to deploy the money. Because if they don't deploy the money, they can't make returns. If they don't make returns, they don't have a business. So in other words, there's this artificial increasing of price because people have to start deploying capital. So what you'll see for the biggest firms out there, and this should make a lot of sense when I say it, for the biggest firms out there, they can't keep doing 5, 10, $15 million investments in startups. They need to make big investments, okay? That's why you see, 200 million plus from Sequoia going into like an FTX as an example. This is why you see someone like, lots of celebrities, but like Kevin O'Leary, for example, invested a bunch of money into FTX. And the problem is you would think traditionally that the amount of due diligence being done is massive. You would think that, okay? You would think that. But there are many ways to get past all of that, right? Oftentimes you say, oh, they're geniuses. We just don't understand them. And so what happens is you get a little loosey-goosey on the due diligence. I'm gonna give you a real example of how this actually happens because I have literally been in the room for these meetings, not with FTX, thank God. But I want to give you a real example. But before I close the thought on this, it's just really important to understand that like you sort of have this laddering of like, I have to deploy capital. FTX sounds like the best thing. I better go into that. And the next group is like, geez, I missed that last round. I got to get into the next round and the next and the next and the next and the next. And before you know it, you have these insane valuations. We saw it with WeWork. We see it with SoftBank's fund. And even ironically, again, we just saw Adam Newman of WeWork just raise an absolute boatload of money again for essentially what is an idea and still not hearing anything about it, right? And so it's important you understand all these different components, right? The cryptocurrency versus token, creating your own currency, the way VC works, the timelines of how money is deployed. And if you step back for a second as a retail investor or just a normal person, you can see like, wow, geez, this whole practice is based around throwing as much money as big as possible and as fast as possible to try to make sure you get gains so you can grow and raise even more money. Now, I'm not saying due diligence doesn't happen, but it may not happen in the scale that you think it does. Now, let me flip the tables over for a second, giving you the example from an angel investor's perspective. So As I said in the beginning of the call, I'm an angel investor. I do make investments in that world. I have never once made a direct investment into any crypto or token related company because, frankly, I just didn't. I mean, it's not because I saw something coming 5 years ago. Certainly, that's not the case at all. To be clear, I just never understood what they were asking me for the money. It never made sense to me. Now, I want to give you an example of how this works at the angel level. Oftentimes, so a lot of angel investors will work independently. I do. And then there's also angel groups. I was part of an angel group a while back. That's when I saw all these deals come across. So an angel group is essentially like, there's no like limited number or maximum number, but it's a group of people who get together and invest together. There can be much, much bigger groups, and there can be sort of smaller groups that maybe focus on a specific area. I'll give you a perfect example. The group that I was sort of sitting with was very focused in like a specific geographical area. We were really looking for like local startups, local businesses trying to support our area. And we were really looking like healthcare, biopharmaceutical, and then occasionally tech if the deal made sense. So just to hold that thought for a second, what would happen a lot of times is we would have maybe a monthly meeting, and you'd have 3, 4, maybe 5 teams come in and present their company, their product, their ask, what they're raising for, etc. And sometimes you see good stuff, sometimes you see bad stuff, right? But for the most part, we wouldn't see them until they had already been vetted by a much larger group that had done full-blown due diligence. And with that would come boatloads of documentation, all the work that was done. We're, of course, open to do our own. But the idea is the first round really got through a much bigger group and now is getting specialized into who really works in these functional areas of investing. So you could see the same people potentially, but I just want to set the stage. It's not about raising money, it's about using your own money, but it's a group of people who have their own money so they can make a bigger play versus like, I don't want to throw you 50K to start your company. I'd rather you get $1 million. So I need to get 20 other people to come in with me, right? So that's how you would get to that number. We all de-risk the investment. We all can potentially help, right? There's ex-CFOs, there's ex-entrepreneurs, there's et cetera. The thing that started coming across the table more and more was this idea of more disparate projects, okay? I think for anyone who watches this channel, I felt very lucky that I understood the value of what blockchain could be, and I think still can be. I think that I definitely understood the value of what a cryptocurrency in its true form could be, right? Recording transactions, smart contracts, right? The ability to look back and see what happened on the chain. This all makes sense to me, especially with a limited supply of something that also created some directional pressure on price. So as someone who wanted to get into that, made a ton of sense. Doesn't mean you can't have divergence, doesn't mean it will always work, doesn't mean it'll last forever, but at a thesis level, there was sense there. The problem was the projects became more and more, they're not solving things. They're creating problems that have been created from the crypto world that only will affect people who are unbelievably deep in the crypto world. Much the same way that no one ever felt the need to have rights to a picture on their computer, suddenly that was a booming industry. So seeing some of these things come across the desk was very interesting. As an angel investor, you can't raise money, so you have to be very selective in your process. That's why a lot of the angel investors I know have all completely stayed out of any kind of funding whatsoever for crypto. Now, let's start going back up again. In recent news, we saw the fact that FTX was invested in like an unbelievable amount of companies, including publicly traded companies. They own 30% of Scaramucci's hedge fund Skybridge, right? They were literally on the cap table. They own 7% or so, as I understand it, of Robinhood. I mean, they had their hands in everything, which really leads you to the point of saying, like, they came out of nowhere, had tons of money, instantaneously had massive reputations for being geniuses, by the way, with really limited expertise or experience. On the other hand, you've got the Gemini Winklevosses, and you've got Brian over Coinbase, and these guys have gone through the ringer as far as like trying to get these companies up and running, trying to get regulated, trying to work with the U.S. government to be regulated exchanges, places where people can put their money. I'm not endorsing them, by the way. I'm just saying, like, what a difference. They're regulated and watched by the US. All these other companies are completely working offshore. And I hear this theme thrown around a lot, this idea of the Wild West. Now, the problem with the Wild West is there has to be some assumption that these people creating these companies aren't out to hurt people. Okay. And I think it's easy in the beginning to think that that's the case, but more and more, as we all learned in the past couple of years, a majority of these tokens were rug pulls. Essentially, they would get people really pumped up, promise huge gains. They're going to change the world. They're going to put people on the moon. It's like, whatever. People jump in and they get absolutely obliterated because the price instantly crashes down. And all the retail folks lost their money. The people who started it and invested in it sold at the very top and made tons of money. And essentially, that's a rug pull. We saw this happen time and time and time again. And credit where it's due, there's actually a really great channel on YouTube. This dude, CoffeeZilla, I wish I knew his real name. I actually don't. I'd shut him up. But like, this guy, CoffeeZilla, has really done a good job of exposing a lot of people who are frauds in this world. And, he's all over the FTX thing, as you can imagine. So again, that's another piece of the story, though, this whole angel piece, the VC piece, the differentiation, why they have to deploy capital fast and a little bit loosey-goosey, whereas angel investors can't do that because it's their own money. They have to do real due diligence. So it's funny when you see that angels don't want to get involved, but VCs do. So we've talked about a bunch of stuff. So let's think about one more topic here. We also saw some breaking news recently in and around this idea of what FTX was paying for marketing, for advertising. They've got their names on stadiums. They were paying, I actually can't believe this is a real number, what I'm about to say. Let me say this, and I have no, I don't feel the need to say this. I'm just making this a really good point. If you're watching this channel and you just are not looking for someone to tell you what to buy, you just want to learn about how to invest, how to think about investing, whether it's one asset class or another. The reason why I make such a big deal about saying I'm not trying to sell you anything, I have nothing to sell, I don't want your money, it's because I don't need your money. It's not, there's no ego in that statement. I'm literally just enjoy doing this and want to provide some value. And a lot of my friends that I talk to, and also maybe do some stuff online or on Twitter, on YouTube, whatever, it's sort of the same boat. That's why I don't have sponsors. That's why I don't have courses. I don't care about any of that. It's not, this is just what I do as something I like to do. This is not a derivative value for me or something I make a living on. But we found out the other day that FTX was paying YouTubers. This is apparently true. $50,000 a month to sponsor them. $50,000 a month, $600K a year, to simply say, I'm assuming a 30 to 60 second little pitch or whatever, and probably throw something on the screen or down below type of deal. You got to really stand back and ask yourself, how could they be raising so much money and making so much money and advertising so much? I know that hindsight is 2020, team, but this is going to happen again in the future, again and again and again. I watch Formula One. I'm a big fan of F1, and every single car, ad, commercial, space on the suits and the cars is like crypto companies or crypto coins or tokens. And you have to ask yourself, how can an industry that didn't exist be worth trillions and trillions and trillions of dollars? Well, it's simple. When you can create your own money out of thin air, you can value yourself at whatever you want. Okay. And I also think that this speaks to the fact that anytime you see that level of insane, wild advertising in your face at every minute, usually something's going to fall in the end. We saw this in 2008, where every mortgage company in the world was going through the roof. It was as if it could never end. The investment returns were wild. It made no sense. Of course, it's because it was a massive fraud. In 2001, with .com, we saw the same thing. Insane valuations coming from the VC world, as usual, where these companies were producing no revenue. A lot of them didn't even have products. They were just selling an idea of something they wanted to eventually get to. And I think about that today all the time. I was lucky to be there and be a part of that in terms of learning from it. I think about the parallels that we've seen time and time and time and time and time again of how these bubbles start slow and accelerate straight up. And you need to learn to recognize these things, right? So I know I'm not trying to just blabber on here. I have a point. My point is, part of our job in doing this and doing it well is recognizing risks. And if we don't have the skill set to recognize risks, which that's okay, inherently it's okay. But if you don't necessarily understand how to do that, there's a million different ways to invest safely, right? There's a million different ways to protect yourself in your portfolio. Or you can do nothing, not ever touch margin. Don't use leverage. Don't use options. Just dollar cost average in on a regular basis into broad-based funds, things like that, right? Look at ETFs, look at index funds. hire a financial advisor, use a robo-advisor, but something that takes you out of the risk game. Now, I want to talk about this too. I know we're covering a lot of topics, but so much has happened. I just felt the need to get it all out onto one video here. One of the things that has existed and I use on a regular basis is like what I call yield boosters. Most of my overall portfolio is going to be real estate and essentially broad-based index funds and ETFs and or blue chip stocks, things I plan to hold for 20, 30 plus years, right? Leave to the kids. That doesn't mean that I don't look for ways to boost my portfolio. So I might want to do this again. I'm saying this with total sincerity. Do not try to copy what other people do because you don't understand the size and the scope of their portfolio and how they measure and mitigate risk. So I'm saying this for the sake of being totally real. It's not financial advice that you should follow. You need to learn what works for your portfolio and your risk style. So I might overall have, 90% of my entire portfolio in relatively stable asset classes, right? And I want to have maybe 10 or 5% for me in yield boosters or more speculative spaces, you might often call it. So this could mean that maybe I want to deploy 1 or 2% into crypto because I want to try to get some upside. Maybe 5% is into options positions that are non-hedge positions. Okay, so just to be clear, these are positions where you're trying to take profit, not protect. I'm using stop losses. I'm hedging my positions. I understand the risk. I have very little downside risk because I'm totally protecting with trailing stops and stop limits and losses. I want you to think for a second that when they were talking to the young woman who was running Alameda Research, the hedge fund associated with Sam and FTX, she quite literally said on tape just recently, while laughing about it, she doesn't even need her math degree because all they do is basic elementary level math. And they don't use stop losses because it's not a good tool for risk mitigation. Every time I make a video or I post about how I use hedges and stop losses and trails, I'm told, you know what, I don't like doing that because then I'm going to get stopped out and lose my money. It's like, oh my gosh, team. That is the point of it. It's so that if there's a 30, 40, 50% loss, you take a little hit, but you're still in the game. You can jump back in whenever you want. It's not about timing. It's about protecting. Who cares if you miss a couple points of upside if you don't lose your entire portfolio? So to think that a person who's overseeing a hedge fund doesn't believe in risk mitigation at its most basic level and doesn't believe math is being used, the one thing I will say though is I don't know if I would love if someone in the comments who's still at this point in the video would tell me, have you seen that video and when did you see it? Because I only saw it recently, which is stunning to think that existed and no one had seen it, by the way. That is frighteningly terrible. So look, I babbled on a bit here because I want to cover a whole bunch of different topics, but let me hit you with the end point here really quick. No one is a true genius in a sense of time in the market, okay? There's warning signs and indicators, but hindsight is always 20/20. If you take steps to better understand the way companies operate, the risks that are inherent within them, how they make their money, many of the investments you would make, you would probably not make after the fact, right? If you were going to invest in an equity on the stock exchange, and when you called and they, when you did your due diligence, called around, talked to different people, they said, yeah, they, no one buys their products. They don't seem to make any money, but they have tons of capital. You'd be like, well, where's the money come from? You're like, I don't know. I'm not really sure. Well, of course, you would never invest in that. That doesn't make sense, right? Companies don't have to be profitable to be good investments. It can take time to become profitable. They have to have a business model. They have to be solving for a need that's scalable. They have to be able to find a way to acquire assets and deliver them back in a high margin way or a value way. What you just can't do is keep investing in things where you YOLO all of your money all the time. And that's why it's okay to have a piece of your portfolio, if it works for you, that goes towards speculative assets because you're just looking to boost your yield. I get that. I do the same thing. It's just there's so much back and forth hate going on online around this idea of all the crypto people are saying everyone else doesn't get it. Everyone else is saying this is a complete fraud and scam. And I think the reality is, and we all really probably know this to some degree, there's a lot from both sides that makes sense. The middle is probably something more along the lines of the tech is getting better and will become more useful down the road. The way the contracts work will keep getting better and eventually something will come down the road. There could already be the right one that's been created, or we haven't created the right one yet. I don't know. We see even celebrities like Gary Vee, as an example, who's still pushing NFTs heavily. But if you actually hear what he's saying, and I am definitely not endorsing NFTs, by the way, or Gary for that matter. But if you hear the way he explains it, he's not talking about the utility of it today. He's talking about the utility of it tomorrow, a different format, a different way to tie something to it. So this brings me full circle to the very beginning that I really want to double down on as a point here. You have to ask yourself as an investor, are the people who are putting their money in truly at risk, or could they find a way to get their money out and dump it onto you? I think that if you start your general due diligence with what is the worst thing that could happen, that's a great thing. And the other thing I would call out, and I think this is going to be potentially a controversial statement, although I can't believe it would be, if you believe for even a second that your money's at risk, you need to get it away from where it is right away, right? Like people coming out saying like, hey, don't worry about it. It's only FTX overseas, not FTX US. And then 24 hours later, it's like, it was FTX US. Whoopsie, big mistake. Just, you need to treat your money with respect. I understand the world is not perfect. I understand that not everyone is banked. I understand there's poverty. I understand there's this, there's that, and there's terrible things in the world. You need to start with you and protecting yourself, your assets, your money. It's your responsibility to do that. So whether there is some solution that's going to come that's going to bank the world or document the world or put everything in contracts that's available forever, fine. But it all still rolls up through governments who will or will not regulate, who will or will not prosecute, who will or will not look into things. And you have to ask yourself, where are these companies we're investing in? What is the risk of something being wrong or being lied to? Because once this onion started getting peeled, more and more pieces have fallen apart from it and become so obtusely ridiculous, people can't even believe they've invested in it. So, team, I dumped a whole bunch of information in this video. I just thought it would be good to consolidate a couple of different thoughts I had on a couple of different topics. And the reality is, we'll find a way back. There'll be other investments. There'll be other things to look at and get involved in. But this is a great learning experience, if nothing else. So I would encourage you to read, to learn, to study what happened, to understand how it happened, to look at the differences between what's going on here and how it might relate to black pools or dark pools rather, or you might look at like just in general why a crypto is different than a token or why one project is this versus that. Because what we don't want to do is keep investing in bridges to nowhere. Okay. And I think that's unfortunately what's happened here in a big way. What we don't want to do is crybaby about things after the fact when we knew we were getting in for speculation in the first place. Right. And I made a video, actually I've made several videos about this, but I just want to reiterate this final thought and I'll let everybody go here. It is very important that when you go into something, you can differentiate the reason. Is it because you're purely trying to speculate and make some money? Then you do whatever you want to do. Protect yourself. But you want to YOLO on Shiba Ding Dong Kangaroo Coin? Hey, that's on you. But don't scream and yell when the thing goes to zero and is worth nothing. You lost all your money. Okay. However, if you're investing in these projects, in these spaces, because you truly and fundamentally believe it is the future of the world, it is changing the world, I guess what I'm curious is why aren't you going and working at these companies? Go and get a job in blockchain. Go and get some certifications or take some courses in blockchain or in how cryptocurrency works at its operational level, not just what you read in the news or the cover of an article, right? Like go and take some courses on operational usage of blockchain, deployment, variability within it, on-chain analytics. Do all of that work. Become an actual expert, not a social media expert. Because when you're an actual expert, and you're the one in the beginning of this creating these things and working them, you'll really be the one who ends up winning in the end, if that's what you believe. So team, with that, I hope you enjoy the rest of the day. This probably went on way too long, but there's just so many different things that I think are being misexplained or misunderstood. So with that, thanks so much for watching. Appreciate it. Have a great day.